Hello, everybody, and welcome to our joint webinar together with Eurex, RCM-X, Shore Capital Research, and Equity Armor Investments. Today's topic is trading opportunities in European volatility with VSTOXX Derivatives. My name is Eugene Moore. I'm a Vice President of Eurex Equity and Equity Index Sales in the US and will host today's webinar. As said by Ali, first of all, some housekeeping items. Again, thank you for joining today's event. I wanted to address a couple of housekeeping items before we get started. This webinar is going to be pretty casual, so we want your questions. Please use the Q&A functionality to ask the questions. We will answer what we can go through the webinar. If there's anything left, we can do this at the end of the session where you can put additional Q&As. If you are having any issues throughout the event, please use the raise your hand button or the chat functionality, and our admin, Ali, on this event will provide assistance. If none of those are working, please reach out to Ali directly. Her email address is akleinhans@rcmam.com. Lastly, this event will be recorded and we will be sure to send out a version of this recording after the event to you. Furthermore, we would like to add the following disclaimer. The information presented is only for educational purpose. Any decision to purchase or sell as a result of the opinion expressed in the webinar will be the full responsibility of the person authorizing such transactions. No market data or other information is warranted by Eurex, RCM-X, Shore Capital Research, and Equity Armor Investments as to completeness or accuracy, express or implied, and is subject to change without notice. Past performance is not indicative of future results. Futures and options on futures trading involve the risk of loss. All information, communications, publications, and reports, including the specific material used and distributed by Eurex, RCM-X, Shore Capital Research, and Equity Armor Investments shall not be construed as or is in the nature of a solicitation of entering into a derivative transactions. Yeah, that's the disclaimer from our side. Before we kick off, I would like to introduce today's participants of the event. It's Joseph Signorelli. He is CEO of RCM-X. It's David Dawn. He is COO and head of algorithmic trading of RCM-X. It's Mark Shore, which is Chief Research Officer of Shore Capital Research, LLC. And last but not least, it's Joe Tigay. He is the CTO of Equity Armor Investments. In the beginning, I would like to hand over for a short introduction to all of the attendees or to all the participants of the event. Joe, you want to start maybe?
Sure. Well, first of all, Eugene and Eurex, thank you for helping put this together today, and we appreciate the opportunity to be able to present in front of the joint audiences. So thank you. RCM-X is an execution algo provider. We're an independently owned algo provider. We're focusing on the futures industry, and for the most part, our team is a quantitative analysis team with, I think, very good technology. We're looking forward to the growth of the Eurex products and working together on providing quality execution to all the different clients out there. So thank you for this opportunity.
Sure, thank you. Handing you over to David. Any comments from your side?
Yeah, hi, this is David Dunn. I've been working with Joe for about 18 years in a variety of capacities, whether it was earlier in our careers as quantitative portfolio managers, doing things like market making and market neutral equity, and intraday stat arb on equities and futures, and more recently managing RCM-X's technology, both its execution algorithms and its solutions for deployed software for clients looking to accelerate their time to the market when building systematic trading strategies.
Okay, great. Thank you, David. Next one in the group is Mark, our old friend, Mark Shore. Mark, you want to say something?
Sure. Well, first of all, thank you for inviting me to be here today. So my background is I have over 30 years experience in the capital markets, primarily in futures, alternative investments. Started on the floor for floor of the Chicago Board of Trade for a small investment boutique called E.F. Hutton. So I was there in '87. So I witnessed the crash of '87, and then I moved into the grain room just in time for the drought of '88. So my career started with volatility. So I definitely understand that. I've done several different things within the industry. I worked at Morgan Stanley for about 9 years. I was part of an internal CTA that they had, where I came there initially developing systematic trading models. When I left, I was the COO of the business unit. I was also head of risk for a Swiss-based firm that invested in fund of funds. And then more recently, I was director of CoQuest Institute at CoQuest Advisors, where I was writing research, speaking at conferences, and doing educational workshops for investors and advisors. I'm also an adjunct professor at DePaul University and Illinois Institute of Technology. And I'm finishing up my doctoral degree at DePaul. So hopefully that will be done next year, and then I become Dr. Mark.
Okay, thank you, Mark. And last but not least, Cho Tigay from Equity Armor Investments. Also a few words from you.
Hi, yeah, I'm Chief Trading Officer at Equity Armor. Equity Armor is a group of former options market makers from the SIBO. Had a lot of experience in the late 90s, early 2000s. And of course, when the VIX became a tradable product, we were one of the first members of that trading group. And we ultimately became the largest electronic market maker of the VIX. Now in our second careers, we're now fund managers, of course. We're managing 2 funds. We're the portfolio managers of the Rational Equity Armor Fund and the EA Vol Hedge NASDAQ 100 fund. Of course, we're utilizing the skills we learned as market makers in the VIX pit with these new funds to get a volatility hedge strategy. We have a large cap value strategy and a growth the NASDAQ strategy. So we have all of our areas covered there. So thank you for having me, and thanks for RCM-X for putting this together.
Of course. Thanks for joining us. I think we have a good group of people here from the exchange, from the service provider, but also from the investment industry. So I think will be a good webinar today. We have brought some slides with me, so I would like shortly go through the agenda. Ali, when you can switch on to the slides, please. Thank you. So, yeah. Agenda slide is on page number 2. Here we have the disclaimer again, agenda slide. So how this next 45 to 60 minutes will look like. First, I would like to give a short update about Eurex in general. Then I would like to speak a little bit, I keep myself short, on the VSTOXX, on the VSTOXX future. After that, we will get an introduction about RCM and their execution algorithms. And then, and this will be the majority of the webinar today, is the panel discussion. We have set up a set of questions around volatility and around VSTOXX, which we would like to discuss with the round. Yeah, I said, first of all, short update from Eurex. For those who don't know Eurex, I mean, Eurex is one of the top exchanges, derivatives exchanges in the world. We are like amongst the top 3 derivatives exchanges worldwide in terms of open interest and in terms of traded contracts. I mean, we are from Europe, so our mother company is Deutsche Börse Group, one of the top exchange providers in the world, and Eurex is the derivatives arm of it. I mean, we have a very diversified product portfolio. We offer futures and options on the equity space, on the equity index space. Interest rates is in the portfolio, dividends and volatility, of course. And lately, we also got stronger and bigger in the FX space, and commodity derivatives is also covered by our on our side. In the equity index space, I mean, our flagship, of course, is the EuroSTOXX 50, which covers the European top 50 names in the equity market. But then, of course, we also have the DAX, SMI, and some other European single equity names. And also very important, I think, to mention is we are the home of the European interest rate curve from money market to 30-year bonds. Yeah, I mean, I said today's topic is the VSTOXX, but on the index side, we also have been engaging pretty much lately also in the MSCI space, which we have become now the biggest player in terms of open interest for MSCI futures and options, and our segment will be further expanded. Another topic which is worth to be mentioned is the new ESG index space, covering the environmental, social, and governmental standards. And here, Eurex is also a pioneer trailblazer in this segment. That was the trading part. Of course, Eurex as a integrated platform offers also clearing services. This is the Eurex Clearing AG, which acts as a stable counterpart. I mean, CCP is an established standard in the exchange world. So that guarantees that all the transactions will be guaranteed delivered, and the payment will be done. Another important piece in the exchange world is the margining, of course. A couple of years ago, we changed a little bit our margin methodology to a new system called Prisma, where investors are getting the advantage of offsetting their positions and portfolios against each other to have a balanced portfolio. And of course, last but not least, Eurex is also a technology provider, of course. I mean, 7 years ago now, we changed our system from the old Eurex Classic system to the new T7 trading architecture. I mean, in today's world, it's all about latency and throughput, and of course, reliability. So from that perspective, the exchange has established a well-functioning and a well-respected system, which will be used all around the globe. That's in short about Eurex. As said, today's topic is about VSTOXX. I don't want to make the introduction about VSTOXX not too long, but just a few simple facts on VSTOXX. What is the VSTOXX? The VSTOXX is an index which has been developed like 11 years ago between Deutsche Börse Group and Goldman Sachs. It's technically the same index methodology or the same logic than the existing VIX here in the United States. The difference is that VSTOXX is calculating the 30-day implied vol of the EuroStoxx 50 components or of the EuroStoxx 50 options. I mean, there are several rules in place to calculate the index on a regular basis. And as said, it's pretty much the same logic and the same calculation method than the VIX over here. It's as said, just the European equivalent to the VIX over here. What did the exchange then? As said, 11 years ago, we launched this index. And then, of course, that's the next step. We brought futures. And then 2 years later, we brought respective options. So we now have a variety of futures on the VSTOXX. And we also have a set of options available for trading, covering, as said, the 30-day implied vol of the VSTOXX index of the EuroStoxx 50 index options. What can we do with the VSTOXX or with the VSTOXX futures? And this will be shown on the next slide. Of course, and we will talk about this later a little bit in more detail. VSTOXX can be ideally used as a hedging purpose, since we have a negative correlation of the volatility index into the equity markets. So that's one of the topics you can use the VSTOXX as another important instrument you can use also as a trading instrument, and that would be then on the next slide. Of course, there are also relative value trading opportunities between the different volatility indices. I mean, a common strategy will be used by our clients, but probably also around the world, is just spreading the VIX versus the VSTOXX. I mean, in general, both contracts have a pretty high correlation, but of course, external effects. And when we go on the next slide, we can show this a little bit more in detail. We have a graph prepared. external effects like the Brexit or the US election or the European elections can lead to a change in the spread between these two indices or in between these two futures. And out of that, of course, certain trading opportunities arise. And the last opportunity out of the VSTOXX suite, of course, also very interesting for some of the traders, is just the fact that the VSTOXX has a term structure. What is a term structure? It's just the price differentiation between the different expiries. Typically, the VSTOXX, and this is probably a known explanation terminology, is trading in contango. That means the lower or the earlier expiries have a lower price than the longer running expiries. But, and that this year is a very good example for that, 2020, we have seen changes in the term structure over time, from having it contango at the beginning of the year, moving over into backwardation at the height of the pandemic in March, April, and then coming back to a regular contango situation. So all of these three specifics of this product give opportunities and potential to the market. That's actually, I said, I keep myself short. That's actually in short about the VSTOXX product. As a second agenda point, we have a short introduction also on the offering from RCM on their algorithm. So I'm handing over to David.
And David, before David gets started, just quickly on RCM-X, David's going to kind of go through a very quick slide deck. Our team brought together an execution algo offering by bringing together our practical experience of being capital structure arbitrage, market neutral traders on all different fronts. We managed our own execution for all our different alpha trading over the decades. And we felt it was important to build technology that can lead to the microstructure of the markets efficiently for clients. And eventually we came up with the concept of competing in the execution algo space. So our practical experience along with our technology is a very important aspect within our competitiveness in the business. So I'll let David take it from here. And David, if you can walk through the slides for everyone, would be great.
Yeah. So at RCM-X, we're a technology provider, and one of our core focuses is execution algorithms, particularly for futures markets. Execution algorithms offer a few benefits for traders. One is they help make execution more systematic, which enables a more thorough and rigorous monitoring of execution quality and tying execution quality to changes in which algorithms you're using, what settings you're using in those algorithms, and make it more objective to monitor trends in execution algorithms over time rather than a more subjective execution process. And that monitoring of execution quality in a scientific manner leads to the ability to systematically whittle down and reduce trading costs over time, and really take control over the full cost of trading, not just brokerage and clearing fees, but also market impact, spread crossing fees, and the implicit cost of executing a trade. The different execution algorithms will have different objectives in terms of optimizing, say, slippage versus arrival price, or risk-adjusted slippage versus arrival price, or also trying to control slippage versus, say, an end-of-day benchmark like settlement price. And execution algorithms also help improve operational efficiencies, both by requiring less manual labor on the part of the trader to work in order by hand, but also the operational efficiencies of being able to benefit from sophisticated low latency trading technology without having to invest heavily in infrastructure and development costs. And at RCM, we provide a series of benchmark execution algorithms with familiar names like VWAP and TWAP, percentage of volume, BRISC, which is our implementation shortfall algorithm, CLOSE, which is more of a settlement or end of day style algorithm. In addition to those, we also offer the ability to develop bespoke execution strategies for clients needing something a little bit more specific. And when we build execution algorithms for futures, a key part of the equation is really paying attention product by product to how the futures trade. It's a different set of challenges than firms that focus on equity algorithms with a variety of venues It's more is the product trading pro rata versus FIFO? What are the seasonalities in the product in terms of how volumes and volatilities behave for a specific product across the expiry cycle? How do outright volumes correlate to calendar spread volumes? What does the settlement process look like for the specific contract? With managing futures products globally, there's also a lot to keep track of in terms of how maybe settlement procedures change over time, or how time zone changes affect volumes and volatilities on global products. So there's all these little nuances that are particularly important in trading futures. And then also the kind of global colo infrastructure. So for instance, when facilitating execution algos for Eurex, we're co-located in Frankfurt. And as we heard from Eurex, a lot of the name of the game now is low latency, making sure you can keep up with high data flows. So all of our execution algorithms are built on our own in-house low latency C++ technology stack. And when you're processing millions or tens of millions of messages a second, if you're slow at any of that, you queue up on your picture of the market data, and you're essentially trading against a stale view of the world. When you're going to enter a trade, if you're slow to get to the market, you might miss your trade, have to chase it to a worse price. You might be further behind in the order book than you need to be. If you're further behind in the order book, you're more likely to have more adverse selection on your passive fills. So being fast is certainly an important part of what we do. And then being able to provide comprehensive analytics and TCA solutions to our clients to help them monitor and improve their execution quality over time. And the same technology that we use to build the execution algorithms, we also license out to low latency systematic traders. And by using technology that's competitive for low latency, say market making or event-based trading, means that we're on a more even playing field, managing even like a multi-hour VWAP order and adjusting child orders to current market conditions. And execution cost analysis, putting your execution results in terms of slippage versus a variety of benchmarks, as well as descriptive metrics in terms of, say, what percentage of the volume you're participating in, how often you're crossing the spread. And oftentimes it's a good idea to keep an eye on a variety of benchmarks. Like even if you're trying to say match the settlement price, you don't want to do it by over participating in the settlement and also moving that price. So even if your core benchmark is settlement, you still want to pay attention to a rival price and work the orders to minimize your market impact. And I think that is the end of the quick introduction. We do offer a variety of deployments in terms of being able to plug and play with many different ISVs and trading screen front ends, also DMA setups where it's just a fixed connection to us and a DMA to the exchange.
Okay, David, sounds very interesting. Thank you for the introduction. Yeah, I mean, we have the exchange, we have the product, we have the our investment partners here on the roundtable. Volatility. I mean, I made a short introduction about the VSTOXX and about how it's calculated, but I mean, volatility is like a longer running topic. I mean, Joe, you mentioned at the beginning, Joe Signorelli, that you have been working in a pit. I think for you guys, volatility was already in the old days in the pit a very important topic, right? So what's your opinion, or what can you share with us?
Sure, Eugene. So being in the crash of '87, I was in the OEX pit. So kind of dating myself with you, Mark. So back in '87, so a lot of the orders that came in were more speculative, and who was really capitalizing on the efficiencies of the markets were the Timber Hills, the Blair Halls, the John Staffords of the pits. And why? Because they had pricing models. And if you look at any of the option trading, it's a boxed reversal conversion to off. So when those got out of line, the large orders that were coming in, guys that were benefiting from it are the groups that actually modeled in volatility. So volatility has always been in the marketplace, right? I think now it's just much more understood as the decades have gone by, more technology. The markets are, the option markets especially are very efficient. And I think but it definitely, if you look back, the opportunity to trade and take advantage of information, if you had that information of volatility was easier back then if you had that. But now everything's pretty efficient because of all the modeling and all the technology going forward.
Yeah. Okay. Good. Joe, I mean, making the bridge from the old days, from the pit now to the all computerized trading. Joe, TK from Equity Armor Partners, what's your opinion on that? How is influencing the topic volatility your business today?
Yeah, well, that's a great question. Really, a big innovation, of course, is turning this volatility into a futures market with the VIX and the VSTOXX, and that was a big change. Now, volatility, and we trade volatility as an asset class, but before there was a future on the VIX or VSTOXX, that asset class was just in put options or call options in real options, right? And the only way to make or lose money on that is to make a right-sized bet on the historic or the realized volatility versus the implied volatility. So if you buy a put option in the S&P 500, you're going to lose if the realized vol is less than the implied volatility you paid for. Now, there's a huge difference to owning a future, right? Because you're really only buying in the future the expected implied volatility on that future's expiration. So it's more about the implied volatility, and actually correlates better negatively with the market, with the futures. And that's actually a real big change in terms of viewing volatility as an asset class, because now we have something, the higher negative correlation to the market, and something that people can trade and hold on to get that negative correlation. So that's been a huge change for me. And of course, full circle now, of course, with all the technology that goes around that with these futures trading, of course, RCM-X has been fantastic with that in order to get this execution going and get the speed up, because back before this futures trading, back before in the old days, it was all by hand and carded. Now we're moving faster than the speed of light, and in order to really keep up, we really need this execution to be there.
Okay. Good topic. I mean, we talked about this at the beginning of the session. There are like spread trading opportunity between the VSTOXX and the VIX, for example. What specifically do you think could influence factors like that on the spread between the indices? Not sure, is Mark still there, or I think we had some technical problems. Otherwise, I would go back to you again.
No, Eugene, I'm here. Yeah.
Oh, you're here.
Yeah. It started to freeze up for a while, but I think I'm good, at least for the moment.
Yeah. Maybe give, before we move over, also a few thoughts of you about the importance or the relevance of volatility in today's world.
Sure. So as far as relevance, the way I look at it, volatility is always relevant. I mean, in the current situation we just finished up the elections in the US. We have Brexit, which is bringing in some uncertainty, particularly as we go into 2021, because they're hitting a deadline on this, right? And if you look at, say, VSTOXX futures in March of last year, and then once they postponed the deadline into the end of the year, you saw VIX futures also moving. There were kinks in the curve that occurred. Now we also have COVID, and that is like the big elephant in the room, right? We've been dealing with this for almost a year now. It's had a major influence into the markets and into volatility. Where that plays out in the short term, that's unknown, right? There's vaccines now that are coming out, but if you listen to the researchers, the scientists, they're still saying, really, by the point that kicks in, we're really talking second half of 2021. So there's still a lot of uncertainty there, and that's going to be reflected potentially in the markets. Actually, a really good example too with volatility is not when you have it, but it's when you don't have it, to think about it, right? From a risk management standpoint. So if you think about with, say, VSTOXX, when it sits at the bottom of the range, right? So it tends to trade somewhere between 12 to 15 on the downside, maybe mid-20s on the upside as its resistance level. But when it sits down at the bottom end for extended periods of time, I refer to this as the compressed spring effect, right? It's like compressing a spring tighter and tighter. So as it sits down there, eventually people become complacent, they forget about the downside volatility, and then all of a sudden that's when it pops. So the relevancy is, yes, it is relevant when we have it, but it's also like thinking about, your house being on fire when your house is on fire. But you should think about the insurance for your house when you don't have to think of when it's actually not on fire, right? So people don't often think about that, the volatility when it's not really there, when people are not thinking about it. Regarding VIX, VSTOXX VIX spread, so what could factor that? What could move it? Well, you have a few things. One, they're relative to each other. VSTOXX tends to maintain a premium over VIX about 4.5 volatility points over the longer term. You'll see resistance when the spread gets to about 8, 10, maybe 12. And when that happens too, you have to think about it. Well, what is causing that spread to occur? It could be a few things. One is both of the markets are rallying, which means the equity markets are declining. When they get up to that point where you see the resistance coming in, I think of it almost like as a second derivative indicator. You could then look at the underlying equity indices and say, well, what's going on there? Are they starting to find some sort of base in there? Maybe, maybe not, but it may give you some indication as to what's happening. The other is you may see VSTOXX move and VIX doesn't, because it could be something that is centric to the EU, right? Perhaps Brexit, perhaps it's elections. And I've written about both of those in some articles, and saying that you can see kinks in the curve, you can see nervousness come into the European markets, but you don't necessarily see it in VIX. The other side of it is that there's something going on in the US markets, but it's not coming across in the European markets. So therefore, you may see the markets, the spread narrow in that case. On occasion, you will see them the spread go negative. Now in the past year, you've seen a lot more of that. So that could indicate there's more nervousness either coming into the US markets, or there's less in the European, or it's just a relative possibility between them.
Okay, sounds interesting.
Can I just expand on volatility as an asset class real quickly,
Sure.
Eugene? Sure. So yeah, this is something that Equity Armor trades in our models. We utilize that volatility as an asset class, and just like Mark was talking about, it gets compressed low and then it'll spring higher. Now we like to look at that ratio, and we actually know that while volatility is an asset class, it's going to be different than most other asset classes we know. And I think that's a key mistake that a lot of investors don't realize, is that most asset classes, given a long period of time, are going to have a positive expected value. 20 years down the road, I expect it to be higher, right? Just that's how equities work. You're going to earn money on bonds, even though it's a little small premiums right now. If you buy gold for an inflation hedge, that 20 years a lot down the line should be higher. 20 years down the line, I expect volatility to be approximately in the same space, okay? It's not something that's going to appreciate in value. And like Mike was talking about, it can be compressed or it can go high. And it's actually what happens is what's known as mean reverting, right? And that's a key thing we need to recognize here. So I know everybody wants to run out and purchase volatility when, as Mark said, your house is on fire, of course, but that's not actually the right way to be viewing it. I think the way that Equity Armor views it is that we're constantly holding volatility, and we're actually going to own more volatility contracts when the volatility is low. And then when it goes higher, we're going to utilize that mean reversion, and we're going to trim some of volatility and cut it back. So I think that's one of the rookie mistakes people make when looking at volatility, only thinking about it when it's happening. In fact, you actually should be doing the reverse. You should be contrarian when it comes to volatility, because when it's too low, it's going to want to revert to the mean. When it's too high, it's going to do the reverse.
Yeah.
I also think another thing to keep an eye on with the VIX versus VSTOXX spread is the index composition itself. During the financial crisis, Eurostoxx may have been more overweight in the finance sector, but presently S&P 500 is about 25% technology. So you might expect that there might be more paying risk there, more momentum, style exposure risk in the S&P 500 presently than in Eurostoxx.
Okay, good view. I mean, we talked about the drivers for influencing the spreads. I mean, we have seen in the past 4, 5, 6 weeks, we have the US election, which had a big impact on the volatility side. I mean, now we're having 2021 coming up. We have still ongoing the pandemic. Maybe I start with Mark again. What do you think? What are the near midterm drivers for the spreads next year?
So what I'm looking at is COVID once again. That is the big, elephant, right? That is what's probably going to be driving a lot of this. And an aspect of COVID, if you think about from an economic standpoint, go back to March, April. Globally, a lot of economies were mandated to shut down, right? And so that was shut down while the COVID numbers were going up. They were trying to get the numbers down. As numbers started to come down, economies slowly started to open up again. And then we're back in this point where they're starting to close down again as the numbers are rallying again. I refer to this as the yo-yo economy, because you're constantly closing, opening, closing, opening. We're probably going to continue to go through something like this for the foreseeable future. So that's going to create a lot of uncertainty into the markets and into economies overall as to where we're going to be. So until we're really through this, you're probably going to see a lot more of that. You do have volatility at heightened levels. Right? Even though it's come down from where it was in March, it's still at a high level relative to where it would normally be. Where it is now is usually the resistance level. It's become the support level. And we could, depending on what happens going forward, we could maybe see some more ticks up.
Okay. Joe, any opinion on that as well, on the near midterm effects which could influence the spread?
Yeah. Well, I'm sorry, Joe.
No, I think he was talking to you, Joey.
Okay, yeah, I would say December seasonally, it's a low month for volatility. We have a lot of holidays built in. People take time off around the holidays, so seasonally it's low. I would expect a snapback either way. And of course, yeah, there's still politics too, which is a difference here. We're gonna have a new government in January. What kind of stimulus, what kind of infrastructure bill are they gonna put on? And we have different jobs reporting dates. I think season, like time of the month, you got the first Friday is a really important time here. So it's obviously just the economy is in shatters, and these people are going to react stronger to these numbers. So that's why it's more sensitive to these types of data points.
Yeah. Okay.
Yeah, I kind of look at it a little bit more on, like, being that we ran a lot of factor models on equities for a long time, right? So I kind of look at it and go, just look at some of the valuations out there, and just naturally there's a disruption in the marketplace with COVID, right? And things, business is being done different. You look at the market caps of like a name like Zoom, and you look at Goldman Sachs, and you would think, okay, why would there, you look at these two market caps and you got to go, what's going to change? Is, the market cap like Zoom going to keep going up? I'm using them as one example. Obviously you can pick technology. Sure. What's been in an advantage because of this unfortunate situation with the COVID, and what's been more stable. And then you got to look and go, okay, what's going to change? How are the models, how are the predictions going to come out? Where are the future valuations? Who's got stronger cash positions? All these different factors that the quant, research groups will look at, and they'll drive through. They're still digging through that. And I think that's going to cause a natural volatility effect for different sectors, which is going to be disruptive. And once again, markets as a whole, they go up in an escalator and they go down in an elevator, right? So things, fear and greed indexes are a key component. I think we've had so much in 2020 that the markets haven't, even though I don't think they've really adjusted or really taken in all this information yet. So I think we can just naturally have more volatility just for the fact that I think people haven't figured out, the quants, the researchers who thought they had it all nailed down. Now you have this disruption. What's going to change? How are these different companies going to be affected going forward?
Okay, thank you. Good view. Yeah, I mean, the spread, as said, is one trading opportunity out of this. Another one, and I think this is a key element of the topic, volatility, is just the fact, the negative correlation of the volatility to the equity markets. Yeah, Mark, maybe, I mean, you have like an academical background. Can you explain a little bit about where is this coming from? And yeah, just a few words on that, Mark.
Yeah, so if you think about it, VSTOXX is based off the options of the Eurostoxx 50, right? And if you think about the put call parity, when there's increased implied volatility, you're going to see prices of the options increase, which that will then impact VSTOXX. However, when you're getting equity markets rallying, you're not necessarily going to see a rush of people coming to buy calls. However, you go to the other side of it, when it's declining, when it's selling off, and then you're going to see a lot more people coming in, and you're going to the puts. So the puts really can have a lot more impact on it, and therefore you get the negative correlation.
Okay, Joe, in the daily trading work, Joe Tigger, in the daily trading work, how do you use it? What in terms of hedging? What?
Yeah, so I mean, market makers would just do that delta neutral and just kind of expect that relationship where volatility will go higher when the market goes lower. So you kind of have to adjust your delta. The way that Equity Armor uses it now in our funds, we expect, over a long period of time, the market to be higher. And we utilize that volatility to give us a daily hedge over to smooth out the downside to that portfolio. Now, that said, I think I mentioned this before. Volatility over a long period of time is not going to be higher. So that correlation is very highly inversely correlated, very negative correlation on a daily basis. But the longer time frame you look at, the lower that correlation. Then ultimately, over a year, there's zero correlation. So that's kind of a really important aspect. So again, when it's too low, that correlation is even higher negative. You're going to move up higher on the volatility side when the market goes lower. And when it's too high, that's correlation loses a little bit of that juice. And when the market's down, you don't go up as much in volatility. So again, that's something we take advantage of, is that negative correlation, but again, that the correlation is going to snap back to the mean, and the correlation changes depending on where the volatility is.
Okay.
And another element in that equation, beyond just the behavioral part of people wanting to buy puts when the market falls and things being more chaotic during a crash, there's also a fundamental relationship between the volatility of the equity and, say, the assets of a firm. One of the things we used to look at when we were managing market neutral portfolios was relationship between credit markets, implied vol, and equity valuations through a capital structure arbitrage framework, where you're essentially valuing the equity of a firm as an option on the assets of the firm. So essentially, the equity is a call option on the assets of the firm. And if the assets of the firm start decreasing, the equity option is closer to at the money or out of the money. And as a result, if you think that the thing that's closer to log normally distributed is the volatility on the assets of the firm, naturally, when those decrease as a percentage of the equity, the volatility of the equity of the firm increases. So there's also structural reasons for that short-term negative correlation between the two.
Okay. When we talk about your execution platform, David, you have like a functionality to implement this hedging activity in your platform, or how does it look like?
So the algorithms, we do support spreads, and we're launching next year a multi-leg algorithm called Splicer for trading not arbitrary products against each other.
Yeah.
And so if you wanted to trade, say, equity futures versus fixed futures or VSTOXX futures, that would be enabled by that. Presently, traders can send in just two separate orders, one for the equity component, one for the volatility component.
We have a question. I'm just seeing this here in the Q&A session. Question for David. When building your execution algorithms, how does RCM-X take into account the nuances of different products and the way they trade, both for volatility products and otherwise? Are products modeled individually?
Yeah, so we generate product-specific forecasts looking across the expiry cycle of the individual products, looking at features like, are there monthly versus quarterly expiries? Are monthly systematically maybe less active than quarterlies, or maybe December expiries? What are the tick sizes in relationship to the volumes and volatilities? How does that plus the matching engine of the product, whether it's pro rata or FIFO, determine how we should optimally be posting passive orders to try to capture passive fills when the market's not flying away? And then also looking at, again, how the expiry and the settlement procedures occur, whether it's a 1 minute VWAP going in, or whether it's marked based on the quote at the edge, or whether there's a closing auction for a product. And so how those closing dynamics affect the trade-offs between trading in, say, the open market into the close, or say a TAS product or the option itself.
Okay, thank you for that. And there's another question coming in on that. I think that's from the same person. And how does short-term volatility play into your execution algos?
So the execution algos are dynamically calculating live views on volatility on a real-time basis, volatility spread, order sizes posted, to kind of determine how to fit into the order book in an optimal way.
Okay, thank you for that. Mark, Joe, anything more on the hedging part? But I think we have completed pretty much this topic. Or do you have any more comments? If not, I would move over. So we have been covering the spread trading opportunities. We've been covering the hedging. Just question in the round. What other? I mean, in the beginning, I also spoke about term structure. Yeah, what do you see about the term structure, Mark? Maybe you can explain a little bit more where it's coming from and what opportunities are coming out of that.
Yeah, so when you look at the term structure, about 70% of the time, VSTOXX is in contango, right?
Yeah.
But then you start to see that it'll make movements, may flatten out, and then the other part, it can become more backwardation, which is usually when equity markets will decline. So there's a few different things you can do. One, you can trade along the forward curve. So you could trade front month against nearby, or you could trade the back months. When it does move from contango to backwardation, you'll see the whole curve move, but you're going to see a lot of the movement really in the front months. So you can also trade along that formation, right? Going from backwardation, or going from contango to backwardation, or in reverse, either way. An interesting example of that is from 2014, because I remember I was watching some news program and someone was talking about, well, we've had this nice run in the spring of 2014 with equity markets. Are volatility indices really relevant anymore? And I thought that's kind of an odd question to ask, because that's like saying, well, we're never going to have downside volatility. You're never going to have corrections in the equity markets. They're only going to go a straight line up. During the summer of 2014, you start to see the curve quietly move up, and then in the fall, you saw a decline in the equity markets. And it just kind of gives you an idea to keep an eye on the curve and along the curve.
Okay, thank you. Joe,
Yeah,
Digay?
I would touch on that, and just when you're trading the futures curve, for novices, it's important to know the front month is more sensitive to the movement, right? So typically what we do is we do see that contango where the front month is below the second month, and on down the line you have a upward sloping curve. But when the VIX rises, when the VSTOXX rises, the front month moves faster than the rest of the curve, and that's actually how you get the inversion of that slope. Just important to know, if you own a leap in the future, it's not going to be as sensitive to price movement, because again, this is just a futures contract. It's not predicting tomorrow's move in the volatility. It's predicting where that volatility is going to be on expiration. So it has less of a delta to the volatility, if you don't mind me using some options lingo. So that front month is a lot more sensitive. It's going to get that snap higher when volatility does rise higher, and people who are trading the curve or trading products that utilize the curve should be aware of that. And I think by now they are, that the volatility happens in the front month.
Okay, very good. I mean, you said it, Mark. Typically, volatility is in contango. We saw in March, we saw the move to like a completely backwardation. What, Mark? What do you think that the drivers for this move from like a regular contango in this hard contango, in this hard backwardation?
So if you're talking about back in March, I mean, that was COVID, right? I mean, that was straight out there. No one really knew what was going on at the time, right? So talk about uncertainty. And you know, people were getting sick, people were dying. No one really understood COVID at that point too, right? There was, between then and now, there's been a lot of research. We understand it better. Economically, we know how to live with it better as well. But at that point, you just saw this drastic sell-off in the markets. Now, the other side of it, from a behavioral standpoint, is that the markets did what they would normally do. You get any kind of shock to the system and people will overreact. They sell really fast, and then they'll find some sort of bottom and more of a confidence, and they'll start coming back, and you start to see that later part of the spring. But that's really what caused that formation to change.
Okay. But now I think we're moving back. I mean, we had in October for the election, November for the election, we had like a kink, but I think now we're going back to, when I'm looking at the graphs, we're going back to the normal contango situation. Okay, we got another question from the audience. This is for Mark and for Joe Digay. Any thoughts on how to detect regime changes in vol from low vol to high or vice versa? Mark, you want to start?
So, yeah, I would just kind of go back to what I was stating before. When you watch the curve, right, that starts to give you some sort of sense as to where you could see a volatility regime change. You know, like right now we're in this much higher volatility regime. When you see volatility just sitting down at the bottom, you know, we're in a lower volatility regime. However, as I come back to what I'd stated early on, when it's at the bottom for an extended period of time, you really have to question how long can it stay down there, right? I mean, people were questioning that in 2017 as equity markets were pretty much a straight line up and volatility indices were sitting at the bottom. But you look at that, you can look at, and you look at the curve, and I think that will give you some indications.
Okay, thank you, Mark.
I would actually say, yeah, I mean, a lot of people follow technical analysis on the VIX. I'm not a believer in technical analysis on the VIX simply because it's not something that where real money exchanges hands. And the longer the time frame, it means less and less to me. But on short time frames, if I see a higher high on the VIX, that might catch my eye. Now, when it comes to the contango, I actually have a slight disagreement. Our modeling actually suggests there needs to be a significant break of that contango. More often than not, we get just a slight crack in it, and then it'll snap back lower. So that's just another aspect to it. Now, for me, again, it doesn't really, there's no point in like trying to time this volatility. The important factor is that the market's going to be volatile over a long period of time. Now, there's low volatility, there's high volatility, but for me, we're going to see volatility snap back to the means. That's why, again, I like owning volatility when it's low, even if it's costing me, because I know these futures were going to snap back faster when it's low. And then again, for me, it makes the world of sense to be selling volatility after it starts to rise.
Yeah. Okay. Good point. Thank you. Thank you. We have another question. Yeah, I mean, in March 2020, we had like record high level volatility levels, VIX and VSTOXX around 80, 90 index points. After that, things came down, still on a high level. But what we as an exchange experienced was that also trading volumes and also liquidity dropped pretty much in VSTOXX, but also in VIX. Do you have an idea? I start with Joe. Do you have an idea what could lead to this behavior after having such a volatile, super high volatile levels and then dropping it, but then losing volumes and losing liquidity? Do you have an explanation for that?
This for me?
Yeah.
Joe Tigay. Okay.
Sorry.
Yeah. Okay. So I would just say the market can get tired. All right. We had tremendous volatility. We had tremendous volume for a long period of time in the summer. And now actually, maybe this is a sign that volatility is on the lower end. We're getting lighter volumes, lighter liquidity. That's always a sign maybe something is going to happen to me. And could be potentially a sign of complacency. Now, that said, I wouldn't be reading too much into it. Of course, we're coming to the year end. People take vacations, and maybe this is kind of what happens when volatility gets suppressed.
Yeah. Okay, thank you. Mark, any thoughts on this as well?
I think actually Joe pretty much summed it up pretty well.
Okay.
And another thing we keep an eye on is looking at liquidity in a variety of different ways. For instance, there's just the trading volumes, the quoted sizes. There's how much trading one contract net long might move the market prices, so kind of regressing price changes against volume. And certainly a lot of products we've seen maybe lower absolute volume, higher measures of illiquidity and how much one contract might move the market. But at the same time, trading one contract now carries more risk. So on a risk-adjusted basis, often like the price of risk transfer is not really degraded or even more liquid than it might otherwise be. So like VSTOXX, VIX, now their percentage volatility is actually kind of pretty muted, but the absolute just like vol points change on a daily basis. When the volatility indices are trading near 25 instead of 12, it's twice as high. So trading one contract gives you twice as much risk transfer as it would have, say, a year ago.
Okay. Thank you for your view. Yeah, I mean, we're coming to the end of the event. I think we have went through all the questions. Maybe to summarize, so yeah, we have the VSTOXX as a trading instrument, using it to trade as a spread between VSTOXX and other volatility indices, but also we have the effects of the term structure, of the changing term structure. So that's how you can use the VSTOXX as an instrument. But also importantly, the third topic I would say is the effects out of the negative correlation. So VSTOXX can be used as an ideal instrument to hedge your equity portfolio. I think these three topics are, and we discussed about this now the last 30 to 45 minutes, are making VSTOXX a good instrument for investors in all directions. Again, the trading directions, the spreading directions, but also the hedging direction. So I think we have an instrument which can be used and utilized in many ways. Joe, or every question to the round, any final words from you guys?
Eugene, sorry, before you go to closing, we actually did have one more question just come in.
Okay, very good. Thank you. Let me have a look. Yes, we have from Gerald, we have a question on contango. Contango drives futures down over time. How do you deal with it? Be long and loose, or trail stop buy orders? Maybe that's a question for Joe.
Sure, yeah. Contango doesn't actually do anything in the futures. It just describes the relationship between the front, second, third, fourth, and on down the line futures. If you have a systematic method which rolls from the front to the second, that will drive your strategy down. The way that we deal with it is that we ignore that, and we systematically, dynamically look at the curve and we say, where is the best spot to be long the curve today? And that's how we do it. It's not based on rolling from the front to the second. It's price dependent, and we utilize our wealth of knowledge as former market makers and former VIX traders as to what the best future is to own for this particular day, and that's how we do it in our strategy. But okay, in general, there's nothing about contango specifically that drives down the future. But I think maybe your point, maybe the front month is above where the cash is. That is a challenge. But again, what you're buying with that future is you're buying the expected value of where that implied volatility is going to be on that expiration. So it's different from a normal option where you need that movement to be able to make money. You need your realized volatility to be above the implied volatility you bought.
Okay, thank you for that. Sounds a reasonable explanation. Yeah, again, we are at the end of the session. Any final remarks, words from the audience, from the group?
No, thank you. We appreciate the opportunity, Gene.
Then, yeah, I think we can conclude. And yeah, thanks for all of you to join the call. And I think it was an inspiring session. And thanks to the audience for listening. If they have more questions, please send it over to us. We're happy to respond on that. Thank you very much. Have a good day.
Thanks, everybody.
Thank you.